Hey everyone, welcome back to Corporate Decoder, the place where we reveal the hidden money secrets, and today we are diving into Arogo Capital Acquisition Corp's annual report, a real page turner if you're into blank check companies and their quests. So Arogo is basically a company with money that's looking for another company to buy. Think of it like a matchmaker for businesses. They've been extending their deadline to find this perfect match. And some interesting things have happened along the way, especially with their stock getting moved to a different trading platform. Let's talk about where Arogo's shares are trading. It seems like they were delisted from Nasdaq, and now their securities are on the OTC markets, specifically called the OTC Pink market. This usually means the stock is less liquid and might be more volatile, which is something investors should always be aware of. They mention receiving a Nasdaq delisting notice. Now, what's really important for these types of companies is the money they hold in their trust account. This is the cash they have set aside to actually buy another company. As of the end of 2024, they had about $1 million in this trust account. That's a pretty small amount, especially considering they had over $100 million when they first went public. A lot of that money has been used for redemptions, meaning shareholders got their money back instead of waiting for a business combination. Looking at the balance sheets, it's clear they've had a lot of activity with their Class A common stock. They also had Class B common stock, but that seems to have been converted into Class A shares in 2024. It's a common move for these companies to simplify their structure before a merger. One of the most significant things to note from the financial tables is their net loss. For the year ending December 31, 2024, they reported formation and operating costs of over $2 million. That's a lot of money spent just on existing and trying to find a deal. Now, they did earn some investment income on their trust account, but it wasn't enough to cover those costs, leading to a net loss of about $1.2 million for 2024. This is a big change from 2023, where they actually reported a net income of about $1.2 million for 2024. This is a big change from 2023, where they actually reported a net income of about $1.4 million. This shift shows how costly it is to keep a blank check company running when it hasn't found its target yet. They also have a significant amount of accrued expenses, over $2.20 million as of December 31, 2024. These are costs they owe but haven't paid yet, and it signals a lot of ongoing operational expenses. Their main strategy, of course, is to complete a business combination. They seem to be pursuing a deal with Telink, a Thailand-based company. They entered into a binding letter of intent in December 2024 and later a merger agreement in February 2025. This is their latest attempt to find a company to merge with, given that previous deals with Eon Reality and Ayocan Holdings fell through. The termination of the Ayocan deal in particular involved them not delivering required financial statements, which is never a good sign. And speaking of legal issues, something noteworthy happened after their year end. They are facing a lawsuit from a law firm, Brown Rudnick, for unpaid legal fees. This is a direct consequence of their efforts to secure business combination deals, and it seems like they lost a default judgment in court owing over $800,000. This adds another layer of financial risk and distraction. It's interesting to note that as of December 31, 2024, they reported 0 holders of record for their Class A common stock and warrants. This is unusual and might be a technicality related to how they track ownership, but it's worth mentioning. Looking at their shareholder structure in July of last year, their sponsor, Singto LLC, held a massive chunk of shares, over 2.9 million, representing about 96% of the shares at that time. This shows a very concentrated ownership, which can be a double-edged sword. Now for my take on Arogo. They are a special purpose acquisition company, or SPAC. The core risk for any SPAC is its limited time frame to find a business to buy. If they don't find one, the company dissolves and shareholders get back what's left in trust, which is often less than they initially invested. Arogo has extended its deadline multiple times, now to June 2026. This constant extension signals a struggle to find a suitable business combination. The delisting from Nasdaq also doesn't help their image or ability to raise capital. The lawsuit over legal fees is a clear sign of financial pressure. While they have a new deal lined up with Telink, previous deal failures and legal troubles cast a shadow. The high concentration of ownership by the sponsor also means that public shareholders have less influence. Overall, Arogo Capital Acquisition Corp appears to be in a challenging position. There's significant operating costs, previous failed deals, legal issues, and move to OTC markets paint a picture of a company struggling to execute its primary goal of finding a business to merge with. Investors should be very cautious. The success of their telling deal hinges on many factors, and given their track record, it's far from guaranteed. Alright, that's our breakdown of Arogo Capital Acquisition Corp's latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.